Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcast.
So when you think of the global economy, think of there's always a balance somewhere. The money always shifts back and forth, and there's always got to be a global balance. One person's gain is another person's loss. In a world of beggar thy neighbor currencies, when everybody's trying to force their currencies down, it can't happen across the board, and we can't have everybody exporting without some global demand, and this is what this says. So this is a projection of negative 3.3% for 2010 in the U.S. If things were to turn around again or double dip again, this number would actually decline. And it falls into 2009 levels. That's that much more demand coming out of the global economy from the U.S. consumer. The U.S. dollar, because its deficits are decreasing, is not lubricating the globe, and that's always been the form of dislocations in the world economy. Again, this is very beneficial from a resource allocation to the U.S. It's very negative for the global economy in terms of growth. In this cycle, at this current phase of this cycle, and probably for the next year or so, the U.S., given its relative undercapacity growth compared to the other competitors, the major driver of the dollar will probably be risk and a bad outcome going forward. We don't necessarily see the U.S. dollar moving on growth, and I'll get to that in a second when we get into the three policy choices here going forward. But as you look at this stuff and you see the current account improving, and remember the economists always used to tell us, boy, the current account in the U.S. has to improve because that's what's screwing up the whole global economy. Well, the reality is ultimately it can be a good thing when the U.S. current account improves and the U.S. saves more instead of consumes more and starts to move a lot of that, reallocating a lot of that money globally and starts to move it domestically to rebuild plant and equipment. That's what ultimately we could see if the U.S. current account improves. The U.S. current account improves, it means there's more domestic savings available in the U.S. And less of it is spread from the U.S. out offshore. That's a good thing. In the near term, it's a bad thing when global demand is needed and your primary driver is down here who needs this global demand right now because China, as we said, is driving the wagon and does not have its own global demand. So it's still a very precarious situation, and this idea of global balances that you see through the current account balances is the driver here. We're afraid that the current account could improve again in a very big way if the U.S. consumer goes back into its shell. Here's the current account deficit, again, on a longer-term basis, and just to give you some key points here. Look at this area around 2000 when the current account started to improve a little bit in here. We saw this was kind of a function of the NASDAQ stock market breaking down in a big way, and even this slight improvement, we saw some global dislocations in the economy. Then, of course, the Fed got busy and pumped more and more dollar credit into the world. The current account started to improve, you might notice here, before what was called the zero time of the credit crunch. We already started to see an improvement in the U.S. current account. So even before the credit crunch hit, there started to be a drain of liquidity out of the global economy. We were watching this situation, and we were also watching the whole derivative situation, and we knew global derivatives, a problem somewhere was a problem everywhere. So we thought, well, because of this, in the credit crunch, that the dollar was going to get a major risk bid, and it did when we saw the credit crunch hit us. And this credit crunch, of course, has driven the U.S. consumer into his shell. So it's taken that much global demand, this and much improvement in the U.S. current account deficit out of the global system. And that threatens directly all those export economies in a very, very big way. At the same time, U.S. growth has declined. So you can see how important it is to watch the current account, and you also can see in these stages how important it is for the U.S. dollar to play that role as global liquidity provider through the current account deficit. Now we've seen the current account increase again as we've seen signs of global recovery. Well, again, just a slight improvement. If the U.S. savings continues and we see this turnaround, the job market doesn't improve, we expect this to continue to increase and pressure the global economy and take more and more dollar liquidity out of the global economy. That's probably our call right here, but it can go a lot of different ways, and I'll get to those scenarios in just a minute. As this started to happen back here in the credit crunch, as we watched this and then saw the credit crunch, we predicted that at some point within the next few years that the U.S. current account was going to go positive. A lot of people had laughed at us, but it's very much a potential here for that to happen, just based on, some type of conflagration that pulls international money and especially U.S. domestic money that's offshore back into the U.S. and savings rates increase across the board. So it's a very good possibility. And as we see that, global growth is going to be hit because of it. And we're back to that idea of the U.S. dollar as the major holding currency across the world. And as that ebbs and flows, the relative value of the U.S. dollar, I shouldn't say the value, the relative amount of dollars being pumped out in the world directly through this, we see how markets will act. So this is why we watch the current account fairly closely in here, and it seems to be tracking pretty closely on the U.S. dollar. If you look at that, let me show you this chart real quick, and I'll come back. This is a monthly chart of the current account deficit, and overlaid in the red is the U.S. dollar index, and you can see how this is 2001 when the dollar started in its bear market, down, 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 as more and more dollar liquidity flooded the globe with dollar credit and the creation of all those derivatives were pushed out there. There's more and more dollar supply, so therefore the dollar fell in value. This improvement, the black line, the current account, reflects the credit crunch. The dollar got a nice bounce in here. And it's really been bouncing in here, but we ultimately think if this improves again, the dollar will be picked up in a very, very big way. And if this improves again very, very quickly, this improvement is based on risk, and the dollar gets a major risk bid, and that's how we read that. Let me move up real quick. Micropath. One of the potential paths out of this is this idea that the Fed really just starts flooding the world massively with dollars. When I say out of this, it's to drive more and more global demand in the world. Fiscally, we're out of bullets, it looks like. The desperation Hail Mary pass of another $50 billion that Barack Obama talked about yesterday thrown into the markets, we're not sure the impact here, because it really is a reallocation from one taxpayer to another group, a chosen group that gets the money on federal infrastructure projects, as opposed to moving it into the private sector. So we're not sure that's going to help, but we definitely think fiscally we're close to out of bullets here. Standard monetary policy really is ineffective when rates get around zero. The Bank of Japan has proved that again and again. Standard quantitative easing measures. When the Fed buys Treasury bonds, buys the mortgage bonds, it really just ends up being walled up in the financial institutions. They use it to really continue to bolster their own balance sheets as opposed to lend it out. So that's that game isn't working any longer. So what would change our view on a risk bid and this idea of global demand falling, continuing to be in trouble if the Fed pulls something out of its hat and just starts to buy everything, maybe corporate bonds, all type of private sector bonds, and anything that it can to directly drive money into the private sector, insurance company bonds, things like that, so it doesn't get walled up in the banking institutions. But the problem with that is, although it provides liquidity and global growth support, it really presents a massive inflation risk in a very, very big way. When money finally gets to the real economy, then it becomes an inflation risk. When money just sits on the balance sheets of the financial institutions and the money stock goes up, so to speak, but doesn't get into the real economy, it cannot really be inflationary. But if they were to do this and drive money directly into the real economy, the inflation risks then start to increase in a very big way, and that's why we think it's unlikely they will do this at this stage.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.